Welcome everyone today to the Breaker Resources webinar here with Fortem Wealth, presented by Jackson Securities. I'm Aidan Lane, one of the investment managers here at Fortem. I'm here with Tom Sanders from Breaker Resources. Tom, how are you today?
Yeah, very well, thanks, Aidan, and great to be here.
That's good, Tom. So today's webinar, we're going to start with a little presentation from Tom. We'll give an overview of the company. From there, I'm going to ask Tom some questions about the company and dig a little deeper into what's happening over at Breaker. From there, we'll take live questions from the floor. For the viewers, you'll see on your screen, there's the ability to ask questions. I will endeavour to answer as many questions as possible. However, if we don't get around to all of them, please feel free to follow up with myself, and we're happy to pass any questions on to Tom. I'll do our best to answer them ourselves. So Tom, if you want to start now with a presentation, that'd be great.
All right, thank you very much, Aidan. Just by way of background, I'm a geologist with over 35 years experience in both mining and exploration. I lived in the Kalgoorlie area for 23 years, and when you do that, you get a good appreciation of the extent of the brown cover that you see in this image here, which tends to conceal 99% of the outcrop. Now, I've got a small outcrop here, but generally you don't see anything. So, and Breaker was listed in 2012 specifically to look for large new deposits concealed by this sort of transported cover. The usual disclaimer. Now, we made a discovery, a complete greenfields discovery, 100 kilometres east of Kalgoorlie in 2016. What was interesting here is there's been previous explorers, but this thing was completely virgin, and it's between two operating mines. Interestingly, the cover's only 5 metres thick. And what is interesting now is that, and what's unusual about Breaker is that that discovery is now transitioning into a new gold district. And we spent the early years setting up an early development option. So we've established a robust resource of 1.4 million ounces. About a month ago, we increased that by 40% to take it up to 1.4 million ounces. And what's interesting is that those new ounces are entirely from new work areas. So we released a maiden underground resource, and we released maiden resources on two shallow deposits situated along strike. So it's growing in several areas. We have identified that we've got a likely pit that is 3 kilometres long so far and still growing. And this deposit has a high-grade thread throughout, so that we can change the cutoff to transition underground in the longer term. Now, our strategy has been to, the early strategy was to establish an early development option. I went to North America in 2019. I met a large US gold fund, and they said, well, why develop it now when, although you've got good ounces to potentially kick things off, we can see potential for to increase this. So they got on board, and subsequent to that, John Paulson of the Big Short fame came on board to take 10% to match Electrum, and more recently Franklin Templeton, who manage over $900 billion, have taken 6%. So that is unusual for an exploration company with a market cap of $60 million to have those big hitters on board. So I think they can see the growth potential here. And in the last resource, we've substantiated that. We've demonstrated the ability to grow this resource. And what's interesting, we've already done a lot of de-risking and have a granted mining lease. That de-risking includes feasibility level met and PFS level, Enviro, Geotech, and other studies. We've got 50 kilometres of strike, and we've drilled 280,000 metres of RC and diamond drilling. Now, the motivation for that is for every $40 Aussie that we spend, this is over 5-6 years, we create an ounce of gold. So it pays to drill, and by drilling, we expand the resource and expand and further de-risk a development option. We want to develop this when it's a no-brainer from a mining point of view, and the banks are behind us and the share price is well north of where it is. So in terms of near-term catalysts, we don't stop drilling. We've got 2 rigs going currently, and we're looking to step that up to 3 or 4. There is a labour shortage at the moment, so there's pressures there for pretty much every explorer in Western Australia. And we see ongoing discovery, regular resource updates, and further drill results. So I'll try to give you a summary here in a few slides, and the big picture summary, and then we can perhaps look at a few perspective shots. We're now looking side on at the main Bombora deposit. I've got a Sydney Harbour Bridge by way of scale in the lower left. So you're looking at about 3 kilometres of strike potential. All those coloured dots are drill holes, colour coded by the quality of the intercept. So what we're seeing here is high grade at surface and high grade at depth. The open pit resource is defined above 100 metres RL, which is around about 200 metres from surface, and that is 90% indicated. So that 40%, $40 per ounce that I mentioned, takes into account the advanced state of those ounces, metallurgy studies, and the rest. Now, significantly, the maiden resource came from those circled areas below 100 metres RL. So we've got all that area below that to keep growing the resource. And what you're seeing on this slide are shallow north plunging lodes shown in red, extending about 2.5 kilometres so far. And in yellow, you see the south plunging steep lodes. So grade near surface, grade at depth, and scale. Now, just to put that image in perspective, if you look now on the right-hand side, that cluster of purple dots is the main deposit, 1.2 million ounce Bombora deposit. The recent resource included maiden resources at Crescent Copi to the north and Claypan to the south. Now, all 3 areas where we added ounces are in a preliminary stage of drilling. So we expect this to keep growing. What you're looking at on the right-hand side is 9 kilometres. So this clearly has scale. And that red image that those coloured dots are sitting on the right-hand side is air core chemistry, air core geochemistry, because we see very little outcrop, and we use that air core drilling to guide the follow-up drilling, RC and diamond drilling. What's interesting here is we've got a good understanding of the structures here now after so much drilling, and we're extending those structures into the red areas where there is very little drilling. But what drilling that has been done is getting some significant results. So we expect this to grow, and we see a lot of potential along that cyanide contact, which is mentioned briefly in that last bullet point. So despite 280-odd thousand metres of RC and diamond drilling, that is a long track record of generating ounces, it's still early days. Now, this is a bit of a snapshot of the corporate side of things. things, as at the end of March, we had $14 million in the till. Our cash burn is in the order of $1.2 million a month because we drill aggressively, and the main driver for that is for every 40 odd dollars Aussie, we add an ounce of gold. You can see on the share register strong US representation, 10% Electrum, 10% Paulson, 6% Franklin Templeton. The people behind this are long-term mining industry types, consultants, including me. I only consult to Breaker, but you also have a mining engineer, a metallurgist, a resource lawyer, and Eric Vincent, who is Electrum's nominee and is a former CEO of Electrum. So we've got an early development option, and what we're doing is making it bigger and better, especially given what's happened with some stalled or some stalled developments, some of which are struggling, but we are setting this up to be a long-term profitable. This is an interesting slide because it summarises how the market is valuing our ounces against our peers. So despite the scale, despite the grade, despite the long track record of adding ounces in a geometry that's eminently mineable, the market has not yet latched onto this. So a key attribute of any investment in Breaker is a de-risk baseline coming in at low cost that I believe is poised for a significant re-rate. And you can see the grades of some of our peers in the bottom row on that slide. Now, the rest of the presentation, which I'll go through quite quickly, is designed mainly to give you perspective. This presentation is on our website if you have a bit more of, if you want to drill down a little bit more. But essentially, on the left is a reminder, and we're looking down on the main Bombora deposit, is that you don't see much on the ground, and this is why it was missed by previous explorers. So that cover that you see obscuring pretty much everything is only 5 to 10 metres. So it's enough to hide it, but not enough to interfere with future mining. And what's important here, that mining zone is plus 150 metres wide. I like this slide because it puts the deposits around Kalgoorlie in perspective, including our project. We're along strike from a lot of ounces in the Laverton tectonic zone. But those areas in grey that you see on this slide are essentially the edges of a big rift zone up which the gold and mantle source rocks are coming. So there is a good pattern, and we are part of that pattern. This slide is a brief summary on the background to how we got involved. We pegged it. We liked the structural setup sitting between two operating mines. We liked the fact that these two black lines controlling the gold along strike come together in blue, which is where we're located. We got on the ground there. We found the ideal host rock, an iron-rich dolerite, similar to what you see in places like the Golden Mile in Kalgoorlie and many other deposits in Western Australia. And once we found the right host rocks, we did wide-spaced air core drilling with the simple premise that if you get continuity on a wide spacing, chances are you've got a large gold system, and that's exactly how it's transpired. The key point here is the last bullet. We only ventured out of the main deposit in the last year, and the results of that are reflected in the resource update put out a month ago. Now this deposit is the dominant mineralisation style in Western Australia. There's nothing new about it. We're talking about a cluster of lodes over a wide zone in a magnetite-rich dolerite, similar to the Golden Mile, St Ives, Plutonic, Darlow, many other deposits. These two maps, including the photo in the middle, they're at the same scale. So our main Bombora deposit has a similar strike length to the super pit. Now, I'm not comparing the endowment. The super pit is 60 to 70 million ounces, but a reasonable percentage of that is my expectation in the long term. Our open pit is still growing, as is the underground resource. And a reminder again, we're looking at 9 kilometres, so this is a big system. Cross sections are always instructive. So what you see here in the top part is an indication of what it's like in the top 200 metres. So what you're seeing here is a concentration of steep, flat and west dipping lodes over a wide zone. That translates to high ounces per vertical metre. It translates into a low strip ratio in an open pit mining scenario. If you look in the deeper part of that cross section, you'll see the results of a single reconnaissance diamond hole drilled down the guts of this deposit, and you can see 3 very significant hits. That's not in the resource. And the reason for that is we don't have drilling along strike, but that drilling is in progress now. Some of it has taken place. So we can see ongoing resource growth at depth. And as I mentioned, along strike as well. So we're targeting both deeper underground ounces and shallow open pit ounces. This is a little bit more detail on the recent resource. We're looking side on at the deposit again. You can see these coloured areas in the lower left that showed up in the last resource. You can see these areas in between where we've been recently drilling and where we're waiting for assay results. And you can see areas of likely extension in several directions, including to the north. And just to position that cross section, which I showed you on the last slide, which is also showed here on the right, we're looking basically where it's annotated on the long section here. We're looking here at about 2 kilometres of continuous high-grade flat load. Now, if you're going to go mining, particularly underground, you want to see continuity and you want to see grade. So we're seeing both those aspects here, which makes for good open pit mining and good underground mining. Now, I should say, when you've got high grades, as I've showed you, and you can see in some of these slides, in an open pit situation, you're trying to maximise the profit, not the grade. What maximises the profit is diluting the higher grade material with lower grade material, so you end up with somewhere around 1.5 grams. And that is how the open pit resource is set up. When we go deeper, we'll simply change to the lower cutoff grade to increase the grade of what we're mining. So that was a big picture view of some of the flat lodes. This is a big picture view of one of the steep lodes. You can see it in drill core. What we're seeing here is continuous high grade material, which hangs together well in long section. So we're seeing good continuity in the tray and in long section. And by way of scale comparison, I've got a little inset image of the Penny North deposit, which was bought last year for $300 million. We can pick that up and put it into here, into one of our steep lodes. So, and our market cap, as a reminder, is $60 million. So there's a lot of hidden value here. Our 9 kilometre gold system is within a 30 kilometre zone where we've carried out air core drilling and where we've got good anomalous mineralisation. So we've got potential over 30 kilometres. Now that windward area to the far north, there's historical intersections up there of up to an ounce with little follow-up drilling. We'll be drilling there shortly. So we expect this to keep growing in several areas. This slide is a reminder that the metallurgy is at feasibility level, 3 rounds of it. It indicates essentially low cost processing, because we're seeing good recoveries, moderate hardness, high gravity gold with no deleterious elements. This slide is a reminder that there are other things to Breaker that are also undervalued. In the course of looking for gold, we discovered a nice lithium discovery. This isn't attracting any value in Breaker, I believe. So we're currently looking at ways to unlock value here, together with our project, another project 100 kilometres out of Perth. A spin-off is one option, but we're looking at all options. But it's just a reminder to potential investors that there are other things in here that are of substantial value. So in summary, discoveries are rare. New greenfields gold districts, 100 kilometres out of Kalgoorlie, an absolute T1 location, are as scarce as hen's teeth. So we have scale, we've got grade, we've got an outstanding growth outlook, we've got extensive de-risking, we have very solid shareholders, we're coming off a low value base that's underscored by and supported by that third bullet in terms of the resource and some of the de-risking that's gone on. We've looked at some of the upside. It's only been very quick, but we're seeing kilometric scale structures that are extending into areas that are lighting up that haven't been drilled yet. We've got a track record of growth and discovery at a low cost, and we're going to keep growing this thing to the point where we have a very robust mine, and it's reflected in the share price, and that'll be the point at which we develop. And in the meantime, there'll be several catalysts, including ongoing drill results, regular resource updates, and I believe further discovery. And that pretty much wraps things up.
Perfect. Thank you for that, Tom. That's a great overview of the company and what you guys are doing over at Breaker. So from here, we'll just move into some questions from me, and then we can answer live questions at the end. A reminder for the viewers, there's the opportunity to ask live questions on your GoToWebinar platform. I can answer them as we go along. Okay, so Tom, other than yourself at Breaker, can you provide some insight into the other key people in the organisation and how that sort of pushes you to success?
We've got, the board consists of essentially long-term mining industry professionals, consultants, specialists in their own right. So that has been a key driver. We've got if you walk in our office today, you'll probably you will hit 3 or 4 people, that's it. We have another 20, 25 people that are on site running rigs. So our money essentially goes into the ground, and we've got a proven track record of discovery now and steady growth. And the project's always a key element, but I believe that people are around about on par with any project when you're investing in it.
Okay, and thanks for that, Tom. It's good to hear you have a well-balanced team with a wealth of experience behind you. Looking now to the aggressive drilling that you guys are running, obviously there's a good cash position, and looking at the cash that you have right now compared to cash per month that you spend in the exploration side of things, how many drill holes would you like to put in considering those positions?
Well, our policy is continuous drilling, because every $40 we spend, we add an ounce of gold. We are grabbing both ends of the handle in terms of targeting more shallow ounces for open pitting, and we've started to get an appreciation of the underground potential. Now, that underground potential is important for the long term because it adds longevity to any mining operation. So we have a very flexible attitude in terms of how many holes we plan and go and progress with. For instance, to give you some idea, we do work that opens up discovery options, and when those discovery options come to fruition, we then pile in with more rigs, and that is the plan. So we remain flexible and focused on building value that can be mined down the track.
Okay, so it's not a matter of how many rigs you'd like to put in this year, just the maximum that you could get in.
Not necessarily the maximum. It's got to be balanced with what we're doing. So we've got diamond rigs for chasing deeper ounces, and RC and planned air core rigs for the shallow ounces. So I stand by flexibility. I mean, we will vary the number of rigs to suit to maximise value, essentially. And if we can maximise value by increasing the number of rigs at the appropriate time, we'll do so.
Yeah, that's great, and thank you for explaining that further. And then you've touched a little bit in the presentation on the comparison of your resource and its quality compared to others in the region. Could you take the time now just to speak into a little bit more about what that means for you as a company?
I guess just looking at the positive aspects of the resource. Firstly, we have a high grade element running right through the resource from surface. So that creates optionality when you mine it, because in essence you can mine it open pit or underground if you have high grade and continuity, which is what we're seeing. We have a cluster of lodes near surface over 150 metre wide zone that looks to be in a single 3 kilometre long open pit configuration. That's uncommon. And being 150 metres wide, that creates a low strip ratio situation. So we deliberately went about understanding this deposit early, because until you understand what you're mining, you have a risk, especially if you're trying to mine it beforehand. So I guess we have high grade coming to surface over a wide zone with scale, and I guess that differentiates us from several of our peers.
Mm-hmm. Okay, thank you for that, Tom. And then when considering the techniques you use in exploration, is there anything that you guys do differently as a company, or you just sort of continue to go with the current narrative?
We specialise in undercover exploration. So we've, I guess, finessed our geochemical approach, because when, for instance, we, as I touched on in the presentation, we use early air core drilling to develop a geochemical picture of the bedrock. We don't only run gold, but we run about 60 other elements. So we rely strongly on that. We also use aeromag. There's potential for other geophysical techniques which we're currently appraising, but that's our main approach.
Okay. Moving on to the next question. Why as a company do you continue to expand the resource through exploration rather than looking to a development stage?
I think you only have to be mindful of what's happened in the past with some other companies that have gone into development. Now it's transpired that in retrospect, some of those developments may have been a bit early. So we don't see any risk in building ounces to de-risk this to a point where the banks are knocking on our door, and it's a no-brainer in terms of this being a long-term, robust and highly profitable mine. So we'll keep going it. We'll keep pushing it till we're in that area and it's reflected in the share price.
Okay. That's good. And there's actually a live question. I'll just jump to one of those in between. So Tom, he's just asked, what level of the resource and reserve would you consider moving to PFS or DFS stage, ultimately to progress to a mining stage? So can you provide some insight there?
Again, there's different ways of approaching development. I mean, my preferred way is to initially kick this off purely on open pitting. So, and keep that underground option up our sleeve, but still be able to dangle it to any, say, financier and say, well, look, this has obviously got legs. We're getting away on the early open pit material. We don't, to answer your question directly, we don't have a set trigger. We remain flexible in when we may press the button on development. I think it will become more and more obvious when we are approaching that point, and when the share price starts to, I guess, reflect the inherent value that's in this deposit and the inherent potential to add multipliers to potentially to where we are currently with the share price.
Okay, thanks for that, Tom. We'll just move on to some more questions and then we'll go to live questions from the floor. So you've talked a little bit about certain hurdles that Breaker will have to overcome this year, one of them being a bit of a labour shortage over in WA at the moment with drilling. What other hurdles do you think you as a company will face this year, and how are you positioned to overcome them?
I think you've touched on the main hurdle, and that's the tight labour market. Excuse me. And that's affecting not only drillers in terms of providing drill crews, but people in the assay labs trying to man the grinding and crushing and analytical circuits, getting good people on the ground to man your rigs. So really, that in my mind is the main hurdle. Excuse me. I think if you're an explorer, the main risk is not finding anything. And once you find anything, the next risk is, well, is what you found in a configuration and size that can translate into a meaningful mine? So I think we're over those two hurdles. We're at the tail end of the second point I mentioned. So, and we're looking to take it further on so that the market and the management has absolute confidence in you. When the market and the management have absolute confidence that this is going to be a flyer, that'll be the time to press the button.
Okay, thanks for that, Tom. What I'll do now is we'll move to live questions. There's a few coming through here. We'll try to get around to answering as many as possible, but I don't think we'll be able to answer all of them in this webinar, but we'll have chances to follow up afterwards. So firstly, why have you chosen to explore at Booty and those other areas compared to the rest of the region?
Because we keep intentionally the door open on discovery for particularly more shallow ounces. And our thought process is we've got the structure, we've got the air core lighting up. if we hit another good shallow discovery situation, we create the option to step up our drilling significantly and advance things more quickly. So we have the new gold district essentially, and we're progressively opening it up, but we're doing it in a way that continues to add mineable ounces. So we're about growing those ounces, we're about further discovery, and we're about setting up a development option that is recognised in the market and recognised in the share price.
Okay. Moving on to the next question. This was from Michael. Why do you think the company is so undervalued, vice versa, to De Grey and others, or is it the case that De Grey is overvalued?
I wouldn't like to comment on relative values to peers, but I'll just make the general comment that for any number of reasons, the market isn't always rational in the short term. I think in the long term it gets it right, but in the short term it isn't always rational, and that creates buying situations. And I think, given what I've shown you, this is clearly one of those.
Okay, thanks, Tom. So we've got another question here. It's speaking into the reduced rigs operating. So they recollect there was an announcement made there were 4 dual rigs operating. Today you mentioned there are only 2. What is the reason for the reduced rigs? I think that's answered in the labour shortage. Would you agree, Tom?
That is the reason. The drillers are having trouble manning the rigs.
Okay. In terms of that situation, it seems to be something that's been focused on in these questions. Is there anything that you guys can do to sort of get ahead of other companies that are trying to get, improve their labour, or is it just sort of a matter of doing the best that you can in the situation?
It's a case, you can always do more, and we're always looking at ways that we can do more. But it is largely a case of doing the best that you can, and getting the turnover on the labour reduced, getting more people on board. But there's some things are in our control, some things aren't. So to a large extent, it's doing the best that we can in the environment and taking steps to be able to get more rigs. And so we're working on it.
Okay, that's good to hear. Thank you for that, Tom. Another question here from Shane. What does the reference to the $2,200 open pit shell mean?
The reference in the presentation, presumably?
I assume so.
There's a reference on that slide to where that's come from. That was from a pit optimisation shell that was done on the previous resource, which reconciles very closely to the new resource, done independently using a completely different method and reported in the same way. So what it says is that the open pit mining potential is very large and it's very real.
Okay. And then there's a couple of questions just in regards to capital. So you're sort of spending quite a lot of money through the exploration phase, which isn't necessarily a bad thing due to the aggressiveness of what you're doing. They're wondering, at what stage would you consider raising capital again, considering the situation?
My approach with capital raising is to keep all options open all of the time. You may have a preferred view, but at the moment, as at the end of March, we had $14 million. So with 1.2 million monthly cash burn, we can go a long way. One of the positives of the 3-month assay delay is that we're 3 months plus into our next resource.
Okay, well,
So,
thank you for all this. Sorry, Tom, you continue.
no, that covers it, I think.
Sure. And there's just there's a couple questions that are just asking about the lithium play, wondering about, I think, the allocation of resources there, and what you think the potential value could be. I'm just summarising a few questions there.
We're currently framing that opportunity. We haven't put out a preferred approach going forward, so we haven't costed a preferred approach. The whole idea of looking at ways to unlock value is to do that. Value that's not currently recognised in the market. We're doing it because we want to focus on our main resource and still unlock separate funding to give those other assets the value creation ability they deserve without diluting our bold focus.
Okay, thanks for that, Tom. Then just moving to another question from Jack. So how frequently should regular resource updates be expected, given the extended assay timeframes, etc.?
We're currently framing our budget for 21-22. We're looking at that closely. I think in a broad sense, we're aiming for 6 monthly updates, but we haven't set a time frame as yet for the next resource.
Okay. Well, thank you for that, Tom. There's a few questions here that we might not be able to get to now. We can do our best to answer those futurely. Tom, I'm sure you're happy for me to pass on any questions to you, and how we can get back to people who are still asking the questions.
That'd be great, Aidan.
So, again, thank you everyone for coming along today. Thank you, Tom from Breaker. It's been a pleasure speaking with you and learning about Breaker. It's been a very informative webinar, and thank you for answering all my questions and the viewers' questions as well.
Thank you, Aidan, and thank you, viewers, for taking the time to listen.
Okay, thanks everyone, and here's another Fortem Wealth Port Jackson webinar here with Breaker Resources. We look forward to seeing you at our next webinar. Thank you.
Thanks, Aidan.